Fed Chair Jerome Powell has recently sounded very confident that his mission has been accomplished. And his mission in this case being hiking interest rates. Now, if you look at the US economy, the Fed has been hiking interest rates for quite some time now. And if you think about why they might be doing this, we first must analyze, what do interest rates actually do? Well, they do a couple things, but they have a direct relationship with inflation. So when the economy is hot and inflation is hitting hard, people are losing the purchasing power of their dollars. So dollars are cheap, dollars are losing value, and so the Fed is trying to control that phenomenon. And so what do? They raise interest rates because they want money to be more expensive to borrow. So for example, when interest rates are low, you could borrow money from the bank for a very low price, a very low interest rate. Businesses are able to borrow a lot of money. The economy is stimulated. Even individuals, they can borrow money from the bank at a very low rate, and then they can go and spend it at those businesses. So as you can see, the economy is stimulated, and in that case, inflation is actually kind of good. Right? Inflation doesn't necessarily have to be bad. It can be good in some cases. So if we know that inflation can potentially be good, it still must be controlled. You can't just have insane inflation and it be good. So in order to control inflation, the Fed believes that they need to raise interest rates. And I'm not going to comment on whether I think that's the most effective way to do it. However, that is what they're doing. So they are raising interest rates, and they're making it very expensive for individuals, for businesses to borrow money from the bank. So when they go to the bank and they want to get a loan, or they want to finance a business purchase or maybe a real estate project, they're starting to pay a lot of money in interest. And so even if you've looked at residential real estate, just like single family homes, people are paying a lot of money in just interest, and that's ridiculous. If you think about just a few years ago, what people were paying in interest, they were able to get maybe a 2, a 3, maybe a 4% interest rate. I know I purchased some real estate and I was paying right within that range as far as interest is concerned. Now, if you're looking at interest rates today on a single family home purchase, you're potentially looking at 7 or 8%, which is maybe 4 times more, 3 times more what we were paying just a few years ago. So what does that do to home affordability? It really drops the value of what type of home you're able to afford as a purchaser. So the economy is less stimulated. No matter what, there's going to be less people buying homes because they can just no longer afford the interest payments. So what does that do? It slows things down. It makes it expensive to borrow money for businesses as well. Maybe they need a business loan. Maybe they need to buy some time for their business, right? They're using that money to cover their operating expenses, stuff like that. Or they could be expanding. They could be using that money for marketing purposes or acquisitions, whatever it is, it becomes more expensive. And so these economic restrictions are not really a good thing because they restrict growth of the economy. They restrict growth of businesses. However, we did see some very interesting stuff start happening this year where a lot of people went through sort of a recession or a down market during COVID. And so they've found ways to make their businesses more resilient, and they can still be profitable even if the traditional routes of finance or interest or borrowing don't necessarily work. So people have gotten a lot more creative. And so there are people who are in this economic state that we're in currently, whether we're officially in a recession or not. The job market is growing, people are still spending money, so there are indications that maybe we're not in a recession after all. And so I believe that the Fed is also trying to bolster up what's going on with our battle against inflation, and try to slow things down there. And what they're doing is raising interest rates to make that happen. So it's up to you to decide whether you think it's effective or not, but that is their strategy. So what does all this mean for us? So if we're business owners and maybe investors or people who want to engage in business, and we want to spend our money to grow the economy, to stimulate the economy, even to grow our own businesses, what does that mean for us? So we need to realize that if we want to grow our business, we don't have to do it by 100% cash, by the way. We can use money from the bank. We can go and borrow money on credit cards. We can get loans, right? All these are great sources of finances for us to continue growing our business. And so we could just look at a couple basic strategies. Number one could be an increase in ad spend. So if we want to increase our ad spend, we need money for that to happen. We need to put that money into ads and let those ads bring in new business, and our business grows, right? Now, the second thing that you can do is use that money to acquire other companies. So maybe there's a competitor, maybe there's somebody who has a big book of business and you want to acquire their company because those customers would also then become your customers. So that's another strategy that people are using, and they're leveraging that in order to generate more income even in this scenario. But you do have to realize that it's going to be more expensive. So you do have to do the math on the back end and see, okay, if I was previously paying maybe 5 or 10% in interest, now I'm paying 15 or 20%. Does it eat away at my margins too much? Because if it doesn't make sense financially to keep doing that, to keep investing into your company using these high interest loans, maybe it's not a good idea. Maybe it's a good idea to pause and become more efficient with what you have right now and then scale in later on. Then you can start getting the loans. Once interest rates come back down, and by the way, all the indications of Jerome Powell's speeches are that interest rates may come back down, or at least rate hikes are paused. Now, whether that's true or not, we don't know. And by the way, he's done this several times already where he's sounded a little bit dovish and he's like, oh, well, you know, interest rates are, you know, he didn't literally say this, but he's implying that maybe, just maybe, they might be done hiking interest rates. Right? And then something happens economically, or something globally happens, or something politically happens that causes interest rates to go right back up and continue increasing, right? So those are all important factors that we need to consider. So if we think that maybe this time it's finally over, maybe this time interest rates are finally going to come back down, we need to know that we have a plan, and in the future we're going to be borrowing. But for now, maybe for the next 6 to 12 months, maybe 2 years, we're not going to do any borrowing and we're going to focus on XYZ. Me personally, my strategy is to continue borrowing even with the high interest loans. However, I'm using those loans only on things that I know can produce a lot of income for me. So I did the math on the back end. I made sure that the money that I'm borrowing is being used in such a way that I'm not paying more in interest than I am making from those investments or those acquisitions, or even just in ad spend, right? If I'm making 50% a month on my investment in ad spend and I'm paying 20% in interest, that's still fine because I'm netting the 30% difference. So as long as it makes financial sense for your business to continue using these funds, even if they're expensive, and maybe it's even a good strategy to start acquiring some real estate right now because you can get those lower prices with the increased interest rates. And then once interest rates come back down, you could always refinance. Now, there's no guarantee that they're going to come back down or that they're going to come back down soon, but interest rates do tend to fluctuate. And so when they want to stimulate the economy again and they want people to start spending and growing their businesses and growing the US economy as a whole, they will likely decrease interest rates. And so what that means for us is that we're able to access cheap money again and use it to grow our businesses, to grow the economy, and to continue acquiring other companies or even investing that money in order to get a nice return. So me personally, in my business, I am going to continue borrowing funds from the bank to continue growing the company where I know I can make a stable return. But for things that are more risky, or maybe I'm not quite making enough to cover my interest payments, I will not be using funds to continue investing into that side of the business. So it's up to you to decide whether you think we are finally done hiking interest rates or not. I'll see you guys on the next video.